Hello, my name is William, and I'll be covering the motivation for this project, our methodology, and the key regression results. The central question we set out to answer is, how sensitive are the stock returns of Coca-Cola and AutoZone to movements in the US dollar? To answer this, we used a framework called the FX CAPM, which is a regression model that explains a stock's excess return using two factors, the overall market return and the return on the US dollar index, or DXY. The model is excess stock return equals alpha plus the market beta times the market excess return plus the FX beta times the DXY return. The FX beta is the coefficient we care most about. It tells us how the stock moves when the US dollar strengthens or weakens. We ran our regressions on monthly data from September 2001 to December 2023, which is 268 observations per company, using excess returns above the 1-month Treasury bill rate lagged by 1 month. The results are summarized in Table 1. For Coca-Cola, we estimate an FX beta of negative 0.3644. This is statistically significant at the 1% level. The t-statistic is negative 3.097 with a p-value of 0.002. So we can firmly reject the hypothesis that KO has no currency exposure. In practical terms, for every 1% increase in the DXY, which means that US dollar strengthens by 1%, KO's monthly excess return is expected to fall by approximately 0.36% with all else equal. KO's model explains around 27.7% of the variation in its monthly returns, which is a reasonable fit for a single stock regression. For AutoZone, the story is the opposite. The FX beta is positive 0.3942, significant at the 5% level, t-statistic of 2.22, p-value of 0.027. A 1% rise in DXY is associated with a 0.39% increase in AZO's excess return. The model explains about 14.9% of AZO's return variation, which is lower than KO, and this tells us AZO's returns are driven more by firm-specific factors. So the key takeaway from section 3.4 and 3.5 is that KO and AZO have nearly equal but opposite FX betas, roughly plus and minus 0.38, meaning a stronger USD hurts KO and helps AZO. Now my colleagues will explain why.
Thank you, William. I'm Jiwo, and I'll cover three things: what adding DXY to the model actually does, what happens when we exclude the GFC and COVID periods, and what the company's own financials tell us about why these betas make sense. First, comparing models with and without DXY. When we drop DXY and run a standard CAPM, the adjusted R-squared falls slightly for both stocks, from 27% to 25% for KO, and from 14.9% to 13.6% for AZO. The improvement from adding DXY is modest in absolute terms, but meaningful. The adjusted R-squared penalizes you for adding a variable, so any increase confirms DXY is genuinely informative. More importantly, we see that when DXY is excluded, the market beta is distorted. It absorbs some of the FX effect. This is called omitted variable bias. For KO, the market beta rises from 0.47 to 0.54 when DXY is removed because the currency effect gets misattributed to the market. For AZO, it falls from 0.63 to 0.55. Including DXY as a separate factor gives us a cleaner, more accurate decomposition of each stock's risks. Moving on to section 3.7, which excludes the GFC and COVID-19 periods. When we remove those periods, leaving 220 observations, both FX betas change. KO became slightly more negative, from negative 0.36 to negative 0.39. AZO became slightly less positive, from 0.39 to 0.38. The adjusted R-squared also falls for both, from 27% to 21% for KO, and from 14.9% to 11.3% for AZO. The reason crisis periods matter is that during the GFC and COVID, investors fled to safe haven assets, including the US dollar, while stock markets collapsed simultaneously. This created an unusual correlation between DXY and stock returns that doesn't reflect normal business conditions. Removing those periods gives us a better picture of the underlying structure of the relationship. Finally, section 3.8, grounding the betas in the company's actual fundamentals. KO's negative beta makes complete sense. According to its 2023 10K report, 63.8% of its net revenues, which is over $29 billion, came from outside the US. 84% of its global case volume was sold internationally. When the dollar strengthens, all of those foreign currency revenues translate into fewer US dollars. In 23 alone, exchange rate movements reduced KO's consolidated revenues by 4% and operating income by 8%. AutoZone is the opposite story. It's primarily a domestic U.S. retailer where 88% of its stores are in the U.S. Its positive beta comes from the import cost channel. AZO imported approximately 16% of its purchases directly in 2023, with many more sourced from vendors who themselves import. When the dollar strengthens, these import costs fall, compressing the cost of the goods sold and expanding their margins. AZO's Mexican and Brazilian operations exist but are small. A 10% peso depreciation would only cost about $37 million against its $17.5 billion in revenues. So the import savings dominate, producing the positive beta. Now I'll hand over to my colleague.
Thank you, Jiwo. I'm Resha, and I'll cover how well our model predicted 2024 returns and how an investor can use our result to hedge currency risk in real portfolio. For section 3.9, we use the regression coefficient estimated on the 2001 to 2023 data with no look-ahead bias and plug in the actual 2024 market and the XY returns to generate predicted monthly returns. We then compounded those monthly predictions to get a cumulative 2024 forecast for each stock. The results are in Table 5. For KO, the model predicted a cumulative return of 11.74%, while the actual return was only 5.6%. For AZO, the model predicted 39% against an actual of 23.8%. In both cases, the model correctly identified the direction both stock roses in 2024, but it overstated the magnitude. The error was larger for AZO, which is consistent with its lower R-square. When a model explains less of a stock variation, its out-of-sample predictions are naturally less precise. This highlights a key limitation of the FX CAPM for forecasting. It captures systematic market and currency factor as well, but individual stock returns are also driven by earnings surprises, management decision, and other firm-specific events that two-factor regression cannot anticipate. Now for section 3.10, our hedging strategy. Suppose you have invested $1 million USD in KO on the 1st of June 2026 and you want to hedge your DXY exposure for the next 3 months. Step 1 is identifying the right contract. Since we need to cover June through September 2026, the appropriate instrument is the September 2026 ICE Dollar Index Future Contract, which matches on 17 September 2026, neatly covering our horizon. Step 2 is calculating the exposures. KO's FX beta is negative 0.36, meaning our $1 million position has a DXY exposure of negative 364,000. Because this exposure is negative, we lose when DXY rises. Therefore, we need a position that gains when DXY rises. That means we go long the future contract. As of 4 July 2026, the September future prices was 100.61. Each contract covers 1,000 times the index value. So one contract has a notional value of $100,000, 610. Dividing our exposure of $364,000 by 100,000, 610 give us 3.62 contract, which we run up to 24. Our recommended strategy is therefore to take a long position in 4 September 2026 ICE USD Index Futures contract. If the dollar appreciates, these futures gain in value, offsetting the decline in KO stock returns. It's worth noting that this is an imperfect hedge. The DXY basket covers major currencies like the euro and yen, but not the emerging market currency like the Argentine peso or Turkish lira that also affect KO's revenue. So some residual currency risks remain. To summarize the overall project, we find that currency exposure is a real and statistically significant driver of returns for both KO and AZO, with opposite signs reflecting their fundamentally different business model. The enriched CAPM captures directional performance reasonably well, but has limitation for precise forecasting. And for an investor holding KO, a straightforward future hedge can meaningfully reduce the XY exposure over a short horizon. Thank you for your attention.